Welcome to the third LinkedIn Live of Solving for India together. This time we have a panel discussion with two stalwarts from the industry, Pushkar Singh, co-founder of Tremis Capital, which is a deal advisory firm that helps startups raise capital from VCs and also co-invest up to $150,000 in startups. D2C, SaaS, consumer tech are their key interest areas. And I found Pushkar through the LinkedIn posts that he writes, which has by itself gained a lot of following among entrepreneurs. We also have with us Bhargavi V from Java Capital, a VC fund focused on pre-seed and seed stage investments across Fintech, D2C, SaaS, and deep tech. Thank you, Pushkar and Bhargavi, for joining us today. We invited both of you so that we could decode Fundraise and the venture capital world for the D2C founders. And I've been hosting this Solving for India together as a LinkedIn Live session to help other fellow entrepreneurs on their journey towards scaling up and making their ventures into a unicorn or massive as they desire. And this has been conceived to bring founders, investors like you and other ecosystem players together so that we can collectively learn, build, and grow the sector together. So, Pushkar, let's start with you. Why don't you quickly introduce yourself, like maybe in 20 seconds?
I think you did a great intro, Vishnu. I work for a firm called Tremis Capital. We invest in startups and we also help them raise capital from VCs. That was less than 20
That's great. Bhargavi?
Hi.
Yes,
I think you did the good introduction. So just saying hi to everyone. Thank you for joining us. We'll be happy to answer any question that you have, not only during the session, but do reach out after the session as well. Happy to answer. I represent Java Capital, a seed stage, pre-seed stage VC fund.
Awesome. That's great. Pushkar, let's start with you. You work with multiple investors and also share a lot of insights about the investor's mindset in your page. Is there a right time for founders to raise capital? How should the product, team size, revenue, the cash flows and profitability look like when founders approach an investor? And what is the sweet spot of startups that you take a bet on?
Wow, a lot of questions. I'll try to answer them one by one. There is no right or wrong time to raise capital. Founders should raise whenever they think they are ready. It can be at an idea stage. It can be once you are building an MVP. If you have launched an MVP, there is some revenue. You might also raise capital if you have $10 million revenue. And you realize like capital, see the entire idea of raising venture capital is it can help you grow quickly. So you might take 10 years to reach a particular stage. Venture capital lets you reach that stage in 2-3 years. So there's no right or wrong time. Sorry, what was the second question? What stage we invested?
No, not that. So if that is the scenario, Pushkar, a lot of founders, of course, founders who are experienced, who built companies that or been a part of companies that were either unicorns or very large, are able to pull off the fundraise pre-revenue or at the idea stage, right? So for a lot of first-time founders, I think most of them participating in our LinkedIn live session today are all first-time founders. So this is definitely going to come across to them like, oh, this is what they say, but when we pitch them, they're like, okay, you're not ready yet, or the product is not mature yet, or the revenue is not good enough, or come back later after some time, or we shall pass this because it doesn't work. So a little bit more clarity on, for the first time founders, on how they can demonstrate a PMF or how they can crack the code of fundraise would be great.
Sorry, my apologies. I didn't answer it for first-time founders. So see, if you're a first-time founder, it's difficult to find an investor who backs your idea. Because we all know, like, and it's a cliche in venture capital industry that ideas are cheap. What matters is execution. So anyone can go to a VC with a great idea. But if you don't have a track record, it's slightly difficult to raise capital. So every now and then we hear first-time founders, some super smart kid from IITs raising $2-3 million on a deck at an idea stage. But that's not common. If you're a first-time founder, you understand an industry well, and you want to raise capital, my advice is at least build a basic prototype, build an MVP, launch it, and then show some revenue. Very small revenue is also fine because that is a validation. Then people take you 10x more seriously. There are also accelerators in India, people like Y Combinator or Antler, who invest at an idea stage or pre-revenue stage. But as you can imagine, the competition is intense because then you are competing with tens of thousands of startups. But the moment you can show some revenue, that all right, hey, I have built a product and I got maybe 10 paying customers. I have 10 people who are willing to pay for my product. The fundraise becomes much easier. One more thing, India also lacks seed stage funds. So Java Capital is probably one, but we as a country, we like to come in once we have seen enough validation. So we need more seed stage funds, people who back founders, maybe at a MVP stage before revenue stage.
Wonderful. That's great to hear from you, Pushkar. That's a lot of insights. So recapping that in a short sentence, what Pushkar has to say to the first-time founders is, if you are a first-time founder trying to raise capital, your odds of raising capital will be very thin because there are so many people competing. And if you get to the market and start generating some revenue and project the future basis on the revenue and the numbers that you have achieved, then you are much more likely to raise capital. Bhargavi, what is your take on this as a managing partner of a fund yourself? So we are very keen and excited to hear from you on this.
Sorry.
Bhargavi, you may unmute.
Sure, yeah, sure. See, I don't want to chase away founders. So when I look at first-time founders, right, especially when you're raising at seed, pre-seed stage, a large part of the decision comes down to the founders. So it's extremely important to, one, demonstrate why you are the right person solving for this. So you have to demonstrate that even if you don't have a product or a customer or anything, have you met your customer base? What is the insight that you have gathered which somebody else doesn't know? So how much have you rolled up your sleeve and put your ears closer to the ground? So it's extremely important to demonstrate that I have a unique, unfair advantage over others, where I have a unique insight on what I am solving for and why I am solving for. It's very important to demonstrate. So I think that is one fundamental thing which I would tell founders. I don't want to dwell deeper on revenue and all that. If there are follow-up questions, happy to answer. But just one fundamental thing, show why you are the best for solving this.
Wonderful. Bhargavi, actually large fund partners like Paul Graham and the likes of value investors, when they place early bets, say they primarily look at the founders or the leadership at the helm and their mindset while investing in early stage startups. Is it true for the Indian ecosystem too, Bhargavi?
Yes. So as I said, a large part of investment decision at pre-seed seed stage comes down to founders. So it's going to be an intersection between market and founders, right? So it's very important on the founders proving their knowledge on the problem market which they are solving for. And another important factor for founders is their ability to attract talent. So businesses, especially when you're looking to build a very large business, you need the ability to attract talent and also attract the second tier management and make people stay, right? Make people want to come and work with you. So that's another factor which is very important, which founders have to keep in mind. And it's something, it's a very intangible thing which we would like to know, right, when we are looking at founders.
Awesome. Pushkar, what do your network of investors look at, and what are the 4 key parameters that founders can work on to crack the code of fundraise? Can you decode the same?
I'll try. So as Bhargavi said, it's extremely important to look at the founders. And I guess all of us, everyone in the world has learned from Paul Graham and Y Combinator when he says we look at formidable founders. So we always hear of a term called product market fit, but at early stages where there's no product, what Y Combinator looks at is founder market fit. And we and our investors, we also look at that. What he means by that is, say, if you want to launch a D2C brand, you don't need to be an excellent coder or a financial wizard. Those skills are useful but not relevant to launch a D2C brand. What you should understand is branding, sourcing, marketing. Like, can you create a great story? Can you create a brand? So for an early stage founders, as Bhargavi said, you need to evidence a strong track record or a strong background saying you have an unfair advantage over everyone else. You can't be someone who has worked all your life in finance and then go to a VC and say, hey, I want to launch a D2C brand. You can still do it, and hundreds of people have done that. But then investors won't look at you, won't trust you to do that. If you want to raise capital, you would rather raise something in fintech, something that's more relevant. So this is all investors look at that, not only our investors or we. Everyone looks at that in the early stage because there's not much to go by at an early stage.
Relevance of the founder's past experience is key, right?
Right, for that product.
Wonderful.
I would say that's the most important thing. Secondly, they also look at your team. Like, say, as a founding team, do you have complementary talents? Can you work together and create a great product as a team? Like, as you would know, Vishnu, startups are a very lonely job. Like, as a solo founder, it's tough. So you always need a co-founder to help you out whenever times are tough. So
absolutely,
we might see solo GPs coming up or solo funds, but still even solo GPs prefer multiple co-founders.
Wonderful. So relevance of the founder to what they are trying to do and their past experience on the same. Two co-founders, unfortunately for entrepreneurs like me, we don't have co-founders, but still, or an able leadership or an advisory team to fall back on who can execute things in the absence of a founder. 3.
So like you said, a strong core team, complementary
strong core team.
Once you have launched the product, some traction, saying, all right, I launched the product, say 6 months ago, 3 months ago, you should have some paying customers.
Okay. So traction is not everything. That comes at the last.
Yes, it's not everything. I'll tell you why. Because we are not an exception. Like how any VC looks at a startup is, how scalable is that idea? How strong is the tech play? So say if you have strong traction in an industry or in a market, which can't become massive, you struggle to raise capital. Say, for example, you just start a restaurant in a city. Now, you might have great traction. You started 6 months ago and then you're saying, all right, now
you're getting 100 walk-ins a day, but it's not going to grow to 10,000 walk-ins a day.
Yeah. So scalability is more important than traction. What traction shows is validation, customer validation. That, hey, I have built a good product and my customers are willing to pay for it, at least some.
Absolutely. That makes sense, Pushkar. Bhargavi, on behalf of a fund, what are some of the key metrics when you look at the revenue and the numbers and what Pushkar stated as traction when you analyze before deciding whether a startup is worth investing or not? So could you just elaborate on some of the matrices that you look at when you define or call it as traction, Bhargavi? Unmute, please.
Sure. Yeah. So I would probably talk mainly with respect to a direct-to-consumer brand, right? Startup, D2C startup.
Absolutely.
Because it is not one thing which fits all sectors, right? So we look at different things for different sectors. Let's take D2C mainly. At least we as a fund, we would like the brand to have sales. So we don't typically invest in D2C brands which are very, very early in their journey. So monthly revenue, ARR, which is annual recurring, there is no recurring, but annual run rate, right? What is your run rate of your revenue is very important. And second is, how is your contribution margin looking like to do this? What is contribution margin? It is your material cost, and contribution margins have different meanings, different ways. Different levels are there, but I will tell. So after your material cost, after paying for your distribution expenses, how much money do you make? And then next comes how much do you spend to get the customers, right? So which is your customer acquisition cost. So do you still make money after paying to get customers, every customer, right? So it's very important to know that you may be losing money today. Your customer acquisition cost, CAC, might not recover your I mean, your contribution margin might not be enough to recover your CAC, which is fine, but it will help us to understand how large is the gap, right? How large is the gap between a contribution margin and the CAC. So CAC is going to be a very important metric. Depending on the sector, within D2C, repeat rates become important. And another very critical factor is your channel of sales. Where are you getting these sales from? Are you getting it from the likes of Amazon, Myntra, Nykaa, or are customers finding you and visiting your website and buying the product? Again, here there is no right or wrong. For some categories, actually platforms work much better than own website sales, and for some categories, own website sales are preferable to platform sales. So but the split between these two is very important. So these are some of the metrics. So revenue, contribution margin, CAC, repeat rates, and channel split of your revenue.
Wonderful. And thank you, Bhargavi. I have a few follow-up questions on that. But before that, for everyone who are taking part in this LinkedIn Live, this is for you, and this is to enable you to succeed in your journey as an entrepreneur. So feel free to ask any question that you have, that you want to ask either Pushkar or Bhargavi. They are veterans in this ecosystem of investing, and they are themselves investing money into startups, particularly D2C. So you can post your question in the LinkedIn Live as a comment, and I will be asking that in the session itself. So coming back to the answer you've shared, Bhargavi, if we have to quantify these four aspects, you shared with us revenue, contribution margin, and repeat rate, and these things, right? Yeah, customer acquisition cost. So coming to revenue to start with, what is the ideal revenue that an early stage fund will look at before qualifying it for further assessment? Is it like 1 crore per year or 2 crores per year, or could you share?
See, again, it depends on category within D2C, but what I generally tell found investors, forget your life. Did you lose me?
For a second.
Just for a second.
Okay. So I generally tell founders, forget investors. Okay, you are going to spend the next 10 years of your life in building this business. So it's also very important. Founders should understand whether this is selling, whether this is a product where there is demand, where I really want to spend the next 10 years of my life building the business out of it. And to do that, a certain amount of revenue and sustaining there and growing from there is very important. So, and only after that you go and raise capital, because with capital raise brings a lot of responsibility. So if you want to cut your losses, and if you want to wind down a company or start doing something else, it becomes much difficult once you raise capital. So it's not about 60 lakh rupee annual revenue, or 1 crore rupee annual revenue, or 2 crore rupee annual revenue. For you as an individual, for you to be motivated and to build from a base, what is that minimum revenue which you would want the business to have? before you go and bring some external person in? So I think this is a very fundamental question which I generally encourage founders to ask themselves before going and raising capital. Now coming back to from an investor point of view, for example, D2C brand which is creating something unique, right? Some unique IP, or today you see a lot of molecular research which is coming, and they create products out of it and things like that, right? There, of course, you can't expect a lot of revenue. The revenue might be less, but the uniqueness of the solution and the fitment of the solution becomes important. So, but versus, let's take personal care, and where today there are probably 100 plus or hundreds of companies, right? And there will be a lot of companies at a $1 million per year run rate also in the country today, which is 50 lakh per month. No, so in certain categories where it is extremely crowded, especially, then the revenue threshold which an investor would want might be higher. So for a personal care, maybe it may go to 1 crore per month, for example, without going to details, right? Very high level sense to get a sense. So it depends on the category. Today there are hemp products coming. Or unique products coming in, right? So then depending on the category in which your product is playing in, the revenue requirement will come. But before that, go back to the fundamental question that I told. As a founder, what is the revenue which you want to achieve to know that yes, there is demand, yes, there is a market for this. This is the bare minimum revenue I have achieved, and now I'm ready to bring investors.
Wonderful. That is a very brilliantly put, Bhargavi. In fact, a lot of founders have a lot of questions to ask others, but not themselves, right? So, and you just kind of shed some light on requesting or having a founder look at himself and the numbers to validate and do a self-assessment before he goes out and looks for capital. So, and also from a numbers perspective, could we broadly say it's anywhere in between 50 lakhs per month to 1 crore per month, which would indicate a business ripe from a revenue perspective to be assessed by a VC, Bhargavi?
1 crore per month, you asked? Not every.
Yeah, 50 lakhs to 1 crore.
50 lakh at least, right? So,
yes.
See, even if somebody is doing 25 lakh, 30 lakh per month, it's very important to show a trend of growth. So you could have done 20 lakhs, then next month are you doing 25, 26 lakh, next month are you going to 30, 35 lakh, right? It's important to show the velocity of growth. Also, even if your base at which you start the conversation is maybe a 20 lakh or a 15 lakh, that's fine, right? It's because, and getting that increase in growth should not be with lot of incremental marketing. So while you maintain your marketing percentage and not increasing the CAC by a lot, is there growth coming in? So that becomes very important.
Absolutely. Great, Bhargavi. Pushkar, what is your take on that from the perspective of the other metrics that Bhargavi has shared? Do you agree with them? And if so, what would you call, or what kind of repeat rate do you think is ideal, and what is a good CAC to lifetime value that founders can optimize to achieve? Could you share some light on that?
It's very difficult to say a good repeat rate. Of course, higher is the better, but that's a very stupid answer. So I just think ideally, say, like Bhargavi said, how long do you take to recover your CAC? So in a D2C brand, it's a lot of early stage founders don't measure repeat purchases, or they don't really measure like how often people buy. Because like in a SaaS business, it's really easy to do. But in a D2C brand where you have thousands of customers, or say hundreds of customers buying from every month, it becomes difficult to measure repeat rate, retention. I still advise everyone to do it. So if you're spending $20 to acquire one customer, by one customer, I mean a customer doing one transaction. Like not just to land some customer on your website, but customer doing actually one transaction on your website. And if you can, like if the customer buys maybe twice, thrice from you again in that year, for most categories, that's a good repeat rate. Say for, it might be slightly higher for fashion because you buy cosmetics more often. So maybe 6 is great. But say for clothes, now typically you buy twice or thrice from the same website, similar kind of clothes. So that is also fine. The idea is like founders should also use a concept called payback period. It's very easy to understand. What it says is how quickly does the customer pays back the CAC you spent on acquiring that customer. So say your average CAC is $20. Now from every sale, every transaction you make maybe $5. So you recover that CAC once an average customer does 4 transactions. So some might do 6, some might do 2, but we are talking about averages. So if you can recover that in 1 year, that's great. That is a good rule of thumb in D2C. 18 months is also fine, but more than 18 months, I think you're missing product market fit. So you are great at landing customers on your website through your marketing, but you're not, but you still have to achieve product market fit. Maybe the guys who are buying your product are not the right guys.
Or
Because
not buying repeatedly enough, or they don't like your product enough, or there are so many alternatives in that category for them to choose that are priced better and that are packed better. So all of these things for the founder to work on, right? So I have an interesting way with which we measure our repeat rates, Pushkar, because what ends up happening in brands that are relatively new is you have X percentage of customers that you acquire, and you have the remaining customers who organically buy the product or discover the brand, which could be word of mouth largely, or repeat from your past set of customers who bought in the previous months. I would say when we did a small assessment, it was largely one of these two things, either word of mouth or repeat, because in the early stage of a brand, the organic discoverability is very poor, right? A brand wouldn't be in the Amazon's choice when somebody goes and searches an organic keyword, or a brand wouldn't be in the top 3 positions in the search engines either, right? So could brands take the non-acquired customers revenue and segment that as repeat? Because that's pretty much coming on to their brand every month without paying a dime for that acquisition, right? So if I'm, let's say, getting 1,000 customers this month, in which I'm only paying to acquire 300, then this remaining 700 can be attributed to the amount of money I spent on customer acquisition over the last 6 months or since the inception of a brand. Is that fair to do so?
You can do it. See, again, like all KPIs, all metrics, you have to measure it well. So even if you see, and the second point is you should be consistent. So say if you're measuring something for 1 month, use the same measure for the entire year or 2 years. So what you said is, say you spent X marketing dollars on acquiring customers and you acquired maybe say 1,000. So you can say, all right, the 700 that I can't directly attribute, I'll just assume they came because of my marketing effort or because of my organic reach.
Because marketing is the only thing that I've done, nothing else.
So it can also be word of mouth, but then word of mouth spreads once you do more marketing, once you deliver good products. So whatever metric you use, just be consistent. Just use it.
Absolutely. The reason is also the same, right? Like in SaaS and other verticals, it's easy to measure the repeat rate, whereas in D2C, most people use Shopify and are using marketplaces to sell their products, and a few of them use WooCommerce. In all of these platforms, it's extremely difficult to actually go and measure how much is repeat from one of the customers who placed an order before, and repeats do also occur where they'll put a slightly different address without a space or with an extra space, and it just gets counted as a new customer, right? Or a different phone number. So that's where it gets slightly more difficult, but that was a good answer, and we have many people starting to ask questions finally. So let us look into the questions people are asking. We have Soham asking us, for certain D2C niches where self-manufacturing is important and the startup capital cost is high, what would be the best way to raise funds? So this is, for example, product first founders doing their own manufacturing, or let's say a furniture D2C brand doing their own manufacturing. So Bhargavi, would you like to take the question?
Sure. So while investors don't like to fund a new manufacturing setup, that's the reality, right? Because you don't know how it's going to work, and you're going to put in capital to start a new manufacturing setup. It's not something which is liked, but so I would tell that look at debt options, but without collateral, it's extremely difficult to get debt still in the country. So most of the founders which I have seen have bootstrapped. So you do a friends and family round, or you get capital from friends and family, and then you bootstrap and you set up the unit. However, be very cautious on not to overspend. In many cases, it will be a couple of lakhs of rupees where you might have to set up a small unit to test the market, which is okay. But I have seen founders also going and spending 3 crores, 4 crores to set up units. Of course, there is help from family or somewhere like that. But the sales has not kept pace with that capital investment, right, which has happened. So what happens is later, even if you achieve a very good revenue run rate, probably 1 crore per month, 2 crores per month, 3 crore per month also, but your valuation is mostly going to be as a multiple of your revenue, and the capital cost which you have incurred, some VCs might adjust it and give you a higher valuation, but sometimes you might not be able to get the right valuation adjusted for the capital investment also. So be very cautious to not do intense capital investment before there is a bare minimum sales.
Wonderful. And as a follow-up question to that, we have somebody asking, so in that scenario, founders who are using third-party contract manufacturers are more preferred to begin with until a business has revenue. And it's advisable for anyone to get started with your own manufacturing once they start generating some revenue and the business is PMF'd. Is that right?
Yes, mostly. Today there are ways, even if you have a unique IP, you can protect it, and you can still get it contract manufactured. It's not impossible. So that is the most advisable way, because whatever resources you have, spend it to bring in revenue, spend it to build your brand. Probably divert those additional resources, time, bandwidth, everything, to bring in sales and revenue, and then you can spend on setting up the manufacturing unit or the backend.
Absolutely. So we have Kaveri Basumatri asking us for certain D2C niches where there is a necessity to, okay, once again, this is the same question asked in a different way. So Kaveri, to answer your question, the best way to raise capital to begin with manufacturing is to wait it out until there is enough revenue, or collateralize one of your assets that you have and raise that capital. That's the answer we heard from Bhargavi. And Pushkar, in the D2C market today, almost every category has already started to look like it's saturated in terms of the product range, both in the marketplaces and with the brands directly competing with each other and selling personal care or your, consumer electronics, or you take any category for that matter, even fashion. So, and with customer acquisition costs also shooting through the roof, it's getting increasingly difficult by the day for first-time founders who are not capitalized to prove this few product market fit matrices and prove this initial traction. So is it going to be a level playing field, or it's going to be a field where only those who are extremely well capitalized can survive and thrive, and it's getting more and more difficult by the day for a first time founder to breach the mark and get to the stage where they have 40-50 lakhs in monthly revenue, and then be able and be qualified to raise capital? And if they are not able to achieve these metrics, what a founder should do?
So you're right, D2C is very competitive in India. All sectors, fashion, lifestyle, fitness, So it's difficult to raise capital unless you have a strong product differentiation. Now there would be maybe 50 cosmetic brands. Now you just can't go and say, I want to launch another cosmetic brand. Fund me. You have to show something, either like you're able to sell your cosmetic at a higher price, maybe you have a higher margin, or maybe you're able to acquire customers very cheaply through word of mouth. You have great product review. You have to showcase, you have to evidence something that you have an advantage over others who are slightly different. Otherwise, you're right, it's very tough to compete with these big guys who have raised a lot of capital, who have big war chest, and you're just starting out. But one thing that works in favor of the D2C industry, and that's at least my opinion, is that it's a very level playing field. So you don't need to be a rocket scientist to start a D2C brand. Like, to be honest, you don't need a lot of expertise in something. So you can't do a fintech unless you understand finance, or you can't do a SaaS unless you're a great coder or you have worked in SaaS before. D2C pretty much is very open. You just need to understand consumer mindset, how to create a good brand. So that's a big thing for D2C market. Secondly, the e-commerce industry is growing in India. So even though the competition is intense, the market is also exploding. First of all, India is growing. Secondly, more and more Indians are buying online. And more things. People didn't used to buy maybe bikes online 5 years ago. Now people are willing to buy bikes also online, exercise bikes, regular bikes. So you have massive headwinds. You have a growing e-commerce market. You have a growing economy. And you have more people willing to experiment, buying out different category. So of course, if you really believe, if you want to create a cosmetic brand, go out and create it. You might struggle to raise capital. But if you want to be a D2C founder, find a new niche that not many people are doing and try to do that rather than directly competing with Nykaa.
So finding a new niche is one of the key takeaways from here. I would definitely agree with that. As I myself speak to hundreds of founders a month, day in and day out, I get to come across so many founders doing protein powders, doing the same thing all over again and again and again. And a lot of them have hit a hard stop, particularly because of the kind of customer acquisition costs and the price that they have to pay to Amazon, right? Largely in India, most of them are marketplace first brands. And within the marketplaces, the cost of acquiring new customers and getting to the pole position and being Amazon's choice have also become more difficult by the day. After the HOBs came in, they also bought so many smaller businesses that these new first time or product first founders do compete with, right? Earlier, they only had to compete with a Mama Earth or a Wow Skin Science or some of the top VC funded startups that were heavily funded, but now they have to compete with 100 businesses that are also acquired by house of brands that are trying to scale and bid for all of the keywords that they were earlier acquiring a lot of customers for, right? So and to take for example, I met a founder who shared the story of how the keyword bidding cost for extra virgin coconut oil has gone up 10 times, and it's economically unviable to bid for that keyword and acquire a customer, even if he will have 5 times repeat from the same consumer happening. So things have gone to that level. So what should a founder do? See, a lot of founders are sticking on to, of course, everybody glorifies success like anything, but nobody talks about those founders who fail. At what point in time a founder has to move on, and what should a founder do if they're not able to achieve the kind of metrics that qualifies them for a fundraise and the business is still bleeding money? Should they just do something about it, or what is the way out for a founder?
Okay, so if I can answer that. So fundamentally, I always tell this to any founder, especially D2C founders. Investor comes second. You are building a business because you are passionate about something. You believe you can, this category very well. You have solved probably your supply, and now you're trying to solve your demand, right? So investors come secondary. So the fundamentals for any D2C founder initially, especially at smaller stage, should be to make money. You should not be bleeding money the moment you cross something like 10 lakh rupee per month revenue, right? You may not grow a lot, but it's not difficult to get the metric that if you spend incremental, how much of incremental sale does it lead to? So that math, you can do some experiments and get it right. So, but it is fundamentally important to not bleed money or reduce your burn. The moment you especially cross the 10 lakh 15 lakh rupee per month threshold, which means you are a crore a year business, right? So then at that stage, now after all costs, let's say you're a crore a year business, right? As an individual, how much would you end up earning? Probably 7 lakh, 8 lakh rupees per year, right? So that's what you would end up earning. Now, the next comes, okay, now let me start experimenting a little bit. Can I make this business from 1 crore to 3 crores next year? So, which means your earning is going to go up from 7-8 lakh to 20 lakhs plus, right? Which is actually a very decent earning for a lifestyle business or any individual to achieve as a first stage. So it's a staged approach, but once you are in this path, right, where you have a math, where you do this little micro experiments to see what is the input which is leading to my revenue growth, then you grow your business, but you are also building the important metric to go and tell your investor, hey, I can, if I invest more in the business now in terms of marketing, this is the revenue throughput which is going to come in, and I can't now do it completely myself. I need external support. So that metric is also going to get built, but it's not unlimited, because you will hit a threshold at some level, which is where you have to start solving for larger things, right? So it's something like the challenge of a Mama Earth when they initially grew from a 10 crore brand to a 100 crore brand is very different from growing from a 100 crore to a 500 crore brand. So the challenge is going to be different distribution strategies have to be solved for at that level, which is fine, which investors are aware of. But initially it is going to be solving mainly for your branding and marketing and reducing your burn and sustaining the business on its own. So that is the fundamental thing I would tell to a founder. If it is not growing beyond that 1 crore per year for 3 years or 4 years at length, then it means as an individual, it's not going to be sustainable for you to keep running this. So that is when you should probably start looking at what you can do next.
Absolutely. That makes sense, Bhargavi. In fact, I would align with that thought. Founders who are not able to achieve the metric should focus on profitability and grow their business more sustainability. And profits do come when enough existing customers repeat buy, and you hustle hard and make that effort to reach out to your prospective customers, getting their feedback and having them share a word about your brand and business to their community and network to vouch for your product. So we approach the end of today's call, but we have one last question that I think we can take. So we have many of these founders who have this skepticism, right? When they go to an investor, it's always like taking an interview, and they are nervous, they don't know what to do, and if they get rejected, they often feel intimidated, or they are like disappointed at the fact that some investor has rejected them. So is a rejection does a rejection mean the business is completely unfit to raise capital? How does a founder, or how do they have to face a rejection, and how do they have to take it? Because I know, being a founder myself, I get rejected 6 to 10 out of the times, or probably even in the early days, it used to be 9 out of 10 of the times. And we do see and hear stories of even the successful founders who went on to create unicorns, who landed their fundraise on the 15th or 20th or 30th pitch. Of course, not just continuing to go and pitch with the same metrics and the same things, but having optimized and learned from why it did not work. So from the VC's perspective, I also see VCs as an angel investor myself. So many startups do pitch me to raise capital. So how do they have to face rejection, and how do they have to move on, and what are the key takeaways they have to work on post rejection before they get back in touch with the same investor? Pushkar?
Wow. So I think there's a lot of information on this on internet. Everyone says don't take rejection personally. And of course, it's difficult because you feel rejected. So there was one good analogy I read on the internet. That's not my original insight. So someone said, think of fundraising as Tinder date. So you're just swiping right. If people are not swiping you, that doesn't mean you're bad. It's just that you haven't found your match. So keep swiping right till someone also swipes right. So don't take it personally, but I think it's very easy to say because we as human beings, everyone takes rejection very personally. The only thing the founder can do is say if a VC says I'm not interested, and if you have 2-3 calls with a VC, if the VC knows you well, try to take good feedback. Try to figure out why you are not a good fit and work on that feedback. 50% times you'll get good feedback, 50% you'll get bad feedback, or you'll get some flimsy reason. But at least try to gain feedback if possible. Not all VCs will give you feedback. Usually people will if you have spoken to them 2-3 times, and then they say, hey, no, we are not interested. Doesn't make sense. So take feedback, don't take it personally. But I think there's very philosophical debate, like there are people much better equipped than us to talk about how to take rejection or not take rejection.
Absolutely. So don't lose out on your hope, but at the same time, don't hope for something that is extremely unlikely to happen, and keep swiping right, improving on the quality and the metrics and the traction of what you are building on is the short answer we have from Pushkar. It was so kind and great of both of you to participate in this LinkedIn live session today, Pushkar and Bhargavi. I'd like to thank you on behalf of everyone who participated in today's session. We are going to put the recorded one, of course, in LinkedIn and also YouTube. So once again, thanking you. Let us solve for India together and keep in touch. Have a wonderful evening ahead, both you, Pushkar and Bhargavi.
Thank you so much, Vishnu. Yeah, great interacting with the both of you today.
Absolutely. And wish all of the founders who are here the very best. Bye-bye.
Yeah.
Bye.